Hey traders, Mixer here. Welcome to my weekly live stream trader psychology stream. Um, has I talk about anything with regards to the challenges that you face, regards to the mental side of trading. So hope you guys had a great weekend. So today, what we're going to talk about is biggest mistake that I've ever made, or has what other traders typically make. So I want to talk a little bit about what are those mistakes. First of all, number one, and number two is how you can overcome those mistakes. So let's get started. All right. So here I kind of mentioned four things that typically are the biggest trader mistakes that many traders make. And the first one is no stop loss. Now I can't express how much I've seen this type of mistake being made by traders. Is you buy any type of instrument, whether it's crypto, whether it's stocks, whether it's currencies, whatever type of asset. And the biggest thing, or the biggest mistake, is people don't put a stop loss for many reasons. One is, first of all, they don't think that there's no need to put a stop loss, because when they get into a specific asset, they feel that it's going to only go up or going in their direction. So why is there a need to put a stop loss? Number two is they don't think that, or they think that if they set a stop loss, that the price will go down to their stop loss level or go up to their stop loss level, stop them out, kick them out of the position, and then the trade goes in their direction. So they don't want to incur that loss, and hence the reason why they don't put that stop loss. But quite frankly, the biggest reason is people just don't think that they're going to get stopped out, so they don't put anything. And I can tell you that you can say that these traders, they got into this price, they got into at this level, it's not going to go any lower. Well, it's probably going to go lower. So that's why protect yourselves. It's just like, for example, when people think of putting a stop loss, it's just like buying car insurance, right? You don't necessarily need to use it, because you're not going to get into a car and wish that you got into an accident. It's just insurance. So if the price does get to that level where your stop loss price is, and it gets triggered, if it goes any lower, it protects yourself, because it minimizes the loss that you are going to make. And I want to emphasize that I've seen so many people not put stop losses, and that's one of the reasons why they either, number one, blew up their account, because the price that they actually got in, that it actually does go to zero. Number two is, if you do utilize leverage, you don't necessarily need to see your asset go to zero for you to wipe out your entire account. So I've seen so many, and this is probably the number one mistake that traders make, is they don't put a stop loss in place. Number two, it's kind of related to not having a stop loss, is essentially having no plan. And again, whenever I've worked with so many of my students, I ask them, well, what's your plan for this trade? Well, it's to make money. Well, I would ask them, well, okay, what strategy are you using? So they'll say, well, I'm using this type of strategy. Well, what if that strategy doesn't work? And they don't know what to say, right? They have no plan. They have no backup plan. All they can think of is they're going to utilize this strategy, and then it's going to work in their favor. What if something changes? What if, for example, I've seen some students where they buy a stock, they didn't realize that actually there was news on that particular company, and hence the reason why it was going against them. Or perhaps they don't realize that there is going to be a big news report or the Fed meeting or something that is market moving, and they get into a stock or they get into any type of instrument just prior to that big news, and then suddenly, their account's wiped out, or the position goes against them against them, and they don't realize because they don't have a plan. You don't get into something without not knowing, well, what's the price you're going to get in at? What's the stop loss, right? What's the price that you're going to exit at if it doesn't go in your favor? And also, when are you going to take a profit? Again, I've seen people or traders where they get into a trade, it goes in their favor, but they don't sell. They don't take that profit, and then suddenly the price goes against them, and their profits declining. They don't know, they refuse to take a profit because they would have been able to make much higher profits, and then suddenly next thing you know, they lost all their profit, and they keep holding it, and the price keeps going against them and actually turns a profitable trade into an unprofitable trade. So you need to have a plan. Like, what's the strategy and what's the market condition that you are trading in? Like, what is it that you're looking for? And it's kind of like I've been working with a few of my students lately. Is you got to plan for every type of scenario, right? And prior to the Fed meeting, when they were raising interest rates by 75 basis points, and they're thinking that the market's going to go lower. Well, what if the market doesn't go lower? It actually goes up. What are you going to do then, right? Are you just going to stand pat? Are you going to change your strategy? Are you going to, what is it that you are planning to do? So if you can plan everything in advance, then what type of scenario that the market gives you, then you can react according to, not just emotionally. All right, number 3. Again, this is what I've seen a lot with particularly either Forex traders, CFD traders, or crypto futures traders, is these traders utilize way too much leverage. All right. With Forex, you can get, and again, seems some brokers offer 400 times leverage, 200 times, 100 times, big leverage, right? Where you think, oh, wow, I have access to all this capital or this buying power. Next thing they know is they max out their leverage. Position suddenly goes against them just a little bit, and then suddenly their account's blown, right? And only to see the trade actually work out in their favor just because they played way too much leverage, did not allow any room for some volatility before the price actually went in the direction. So that's what I've seen a lot. I mean, it's great that you can utilize a lots of leverage. For example, if let's just say you use 100 times or 200 times capital, the asset that you bought went up 1% in your favor, you essentially doubled your money, right? So if you capture it right, and moves 1% in your favor, you double your money. But if it goes against you 1%, then you basically lose all your money. So you're banking on the fact that the asset won't go against you or go more than 100% against you. But if it does, let's just say it goes against you 1% and then suddenly reverses and then gets you, stopped out or blown your account, and then it goes in your favor, right? So that's one thing. The third biggest mistake that I've seen is, especially with people who play with leverage, don't know how to play leverage properly. And it's kind of like, if I were to kind of just talk a little bit about this right now, is the way to play leverage is just like, for example, something's working for you. Like, let's just say you bought something and it's going in your favor. Leverage allows you to say, hey, listen, the position is going in your favor. You have access to more capital. Would you like to buy more? Would you like to add to your position because the price is going in your favor? Leverage is not supposed to be utilized when the position is going against you. For example, where you buy something and it goes against you and you say, hey, listen, I have this more capital. I'm going to buy more. Right? And then it goes against you and then you buy more, and next thing you know, your account is blown. All right, last thing, and again, just want to share with you guys, If you have any questions, please type them in the question box and I will talk about that. All right, the last mistake that most traders will make is just being way too emotional. And again, obviously, we're talking on this trader psychology. Emotion plays a huge part in trading. And some of you who have been trading for a while realize this. Um, for some of you who have not, you might think, well, I just follow my rules, right? I buy when it breaks through this level. I sell when I get through this level. I mean, it's very logical, especially when you're not in the trade or you are, let's just say, an armchair quarterback where you look at the past. I should have done this, 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 this. But when you are in the middle of a trade gets triggered, something happens. Okay, because you are invested in that trade. You have money at risk and you fear losing, you suddenly see the price movements up and down makes your heart beat a lot faster. Or if a position suddenly goes in your favor, you start thinking of how much money you're going to be making, all this profits, and suddenly your logical brain goes out the window and suddenly you become emotional, right? Because either greed of making more money or fear of losing money. So that's one big aspect that a lot of traders make mistake, is just being too emotional. And I'll be the first one to admit that when I first started trading, I was on an emotional roller coaster. One day I would be like super happy, next day I would be miserable and thinking of giving up on trading, and then next thing, if I do well, then suddenly I think that I can make a lot of money in trading, and then the next thing maybe throughout the later day, I give up all my profits, and suddenly I'm becoming very emotional. I'm upset. I'm angry at myself. I just want to, you know, throw the computer or, basically, have these highs and lows of trading, basically based on the amount of money that I'm making or that I am losing. So, what's the way to become not too emotional? Well, the thing is, it boils back down to the number 2 point that I have here is no plan. If you have a plan, everything's all planned out. Like, what do you need to be emotional about? You already are accepting of, for example, this loss. If it triggers your stop loss, hey, you get stopped out. Well, was that loss too big? And if you thought it was too big, well, you should have planned in advance that you were comfortable with that loss, right? For example, if you had planned that if it triggers your stop loss at this price level, you would lose 1,000. Well, $1,000 is maybe too much. Well, what's that number? Is it 100? Is it $10? Is it $1? Like, have a level where you're comfortable with losing that amount of money if your stop loss gets triggered. And if when you get into a trade and actually your stop loss gets triggered, you shouldn't feel emotional at all because you've already planned through it. You've already decided that I am comfortable with that loss. And also, for example, when you pre-plan ahead saying that, okay, I'm going to take profit at this level, and when the profit gets to that level and actually keeps going in your favor, you shouldn't be emotional. You shouldn't say, "Oh, I shouldn't have sold," or "I shouldn't have set my my take profit level, so close together," or I should have played a lot bigger. Well, this is kind of where if you kind of plan through everything, and quite frankly, you have no control how much profit that you can make. So that's one aspect that can really help you. And the other thing I just kind of just maybe summarize here before I take any questions from you guys is, if you look at all these mistakes, right? No stop loss, no plan, too much leverage, too emotional, really boils back down to, quite frankly, the number 2 point is you got no plan. And a lot of people, think trading is speculation, right? because you are trying to speculate whether a price is going to go in your direction, right? You, if you're a buyer, you're speculating that the asset that you are going to buy or you're trading will go up in price, and you can use it supporting based on your looking at charts, looking at your fundamentals, looking at the economy, whatever um, supporting evidence or supporting information that you believe this asset that you are buying or trading will go up in value. Well, once you have done your research, done your due diligence, and you just basically let the market tell you, right? If the asset goes up in value, then you're right. If the asset doesn't go in value and goes down, then you're wrong, right? So we're not speculators, right? Traders, a lot of people think that we are betting, right? We're trying to predict the future. We're trying to uh, base all this information and trying to forecast what will happen. It's not. What we're really doing is we are trading what the market is telling us. So I'll talk about this in future videos, but trading is not, it's basically utilizing the information that we have and trying to utilize that information to try to forecast future price movements. Now, I said here future, right? But we're just basing it all on what is currently happening. So, for example, let's just say right now the whole market is focused on high inflation, right? High inflation is everywhere. Cost of living, everything has gone up in value, and obviously has impacted the whole global economy, and hence the markets have fallen because of that. Now, if we're just basically not speculating on what inflation will be next month, for example, or whether inflation will fall, but if we are trading the fact that inflation is a concern to the economy, then we stick with it. We are basically looking at the data that inflation is high, and the Federal Reserve is probably going to have to aggressively raise interest rates, which is also not good for the economy because borrowing costs are going to be a lot higher. So if we just base it on that, then we should not be buying this market, right? For example, so we're just trading what we can say. We can say we're trading the trend, right? The trend is down, so we sell or we short the market. Now, once we have new data, for example, the consumer price index, CPI, PPI, producer price index, inflation data is coming out next week. And if that inflation data shows that there is actually a decline of inflation compared to the previous months, then the market will probably react and probably go up because the market is now gathering this new information. Now, this new information may be signaling that peak inflation has already been reached, and hence all this aggressive rate hikes, all this high cost of living, or high cost of goods and services will finally come down, and hence will benefit the economy. So then, if that is the case, and the market or the inflation does go lower, then we can be confident in buying. So what we as traders are doing is essentially trading how the market reacts to it. We're not trying to predict, hey, what's inflation going to be? I'm going to position myself ahead of these reports, and what am I going to do, to speculate based on that? All right. So that's something that I'll discuss more in a future live stream, and I'll talk a little bit more about that because, again, always there's this preconception or misconception that us traders, we're speculators. We're trying to forecast the future. We're trying to decide what's going to happen. And quite frankly, there is a bit of speculation because if we were to trade purely on all the news, then maybe perhaps the price is already priced in. But I can tell you that the the real traders or the really consistent profitable traders, we're not speculators. We are basically trading what the market is telling us and what that information is telling us. All right, so I'm going to open the floor to any questions that you guys have, and maybe perhaps what are the biggest mistakes that you've made as a trader, and I can give you my comments based on that. All right, so let me just look into the chat box here and see what questions you guys have here. All right, hi, Lurking Luke, and no problem, Dennis. Okay, Richard has a question. What's an ideal leverage to use, 100 to 1 or more? All right. Okay, so as I said, kind of, and I'll elaborate a little bit further, is leverage is kind of like, okay, so think of leverage as a line of credit, okay, a personal line of credit or something that you can access, right? So let's just say, for example, as I said, is you bought something, and let's just say, for example, some of it, not all of it, with cash. You're using some of it. Let's just say 10%. Okay, I'll just make this up for now. You're just borrowing 10% of whatever you have, and the position is going in your favor. Hey, you bought something and it's going up in value, and you think it's going to go higher. Now you have an opportunity because you can pull into your leverage or pull into your line of credit and say, hey, listen, I have more buying power. Let me buy more. So now you are borrowing against or essentially borrowing against your account, utilizing the capital that you have in your account has margin, and now you'll be able to buy, let's just say, another 50% more, right? So with 50%, you're not really utilizing full leverage, right? Because you're not utilizing more than 100%. But what would leverage allow you to do is that you don't have to put all that 50% in cash, right? You can borrow against it. So it's where you start looking at utilizing more leverage than you need, right? So for example, when you, as I said again, if you use the full 100 to 1 leverage, if the position goes against you 1%, you blow up your account. So if you think that the instrument that you're trading is not going to fluctuate that much, right? For example, it's only going to fluctuate maybe perhaps 0.1%. If something's very, very stable, then you can afford to play with more leverage. But for example, if you're using 100 to 1 trading Bitcoin, which can move 1 or 2% or a few percent just against you, just like that, why would you want to do that, right? So it really depends on the type of instrument that you are trading. If you are trading a more volatile asset, unless the position is going in your favor, you don't want to utilize a lot of leverage. If you are trading instrument, as I said again, doesn't move that much, it barely moves, then you can use a lot more leverage because it's not going to kick you out of your position, or it's not going to blow up your account, right? So that's one aspect that you can think of. The other aspect is obviously how confident you are in that trade. I mean, if you're very confident and you've made money in the past and you don't mind risking a little bit more, then utilize that leverage to your advantage. All right, Brian has a question. A plan incorporates an acceptable loss, so no overwhelming losses occur. Yes. And I cannot state that enough. And again, I'll repeat this again, is many people, and maybe this is a preconception that a lot of people think is, let's just say, for example, you are a newbie day trader, for example, you have all these screens, you have all these quotes, you have these charts up, you're set up like a professional. And people think that trading is like it is some sense kind of like a video game, right? For example, and I talked a lot about this in my videos, but it's in the actual art of trading, where you're pressing buttons and getting to trades in and out and all that stuff. Like that's not the fun aspect of trading, right? in terms of pressing buy and sell buttons in and out, that type of thing. That's in some sense, I would say, trading is kind of glamorized, that you click all these buttons and you can make money. The 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 best way, or you can say the most fun way in terms of trading, and actually trading really, really well, is actually the most boring way. All right. So it's where you put on, like, you do all your due diligence, you do all your research, you put in your trade, your entry order, you put in your stop loss, you put in your exit profit, and that's it. And then you let the market tell you whether it's going to reach your stop loss price or going to reach your target price first. Whichever one you will get, you will be exited or kicked out of the trade. And how exciting is that, right? That's not exciting. The exciting part, I can tell you, is when you do your due diligence, you have a plan, you research, you look at the charts, you draw your trend lines, you do your fundamental research, you analyze, you look for some type of an edge in your trading, you look at your strategy, you back test it, you do as much as you can, or within your abilities, to see whether this trade will be a high probability trade. And if the trade doesn't work out, where are you going to get kicked out? And when the trade does work in your favor, like, that's the most amazing feeling, where you have an idea, you put it down into paper, you enter in your order, and the price goes in your favor, and you exit with a nice profit. I mean, that's the most exciting part of trading. All right. Dennis has another question. Sounds like we need to accept losses are part of being a trader. It's often hard to do as retailers or retail traders. Can we assume that as retail traders may need to reset the plan or perhaps come back at another point? All right. Great question, or great comment, Dennis. Is in trading, okay, I'll just say, if you don't lose money in trading, you're not a trader. Okay? If you don't lose money as a trader, or you don't lose or have some trades that don't work in your favor and you lose money, then I would either tell you that you're lying, right? That you haven't lost money, or I can tell you that either you basically have not sold, you may have unrealized losses that you're still holding and hoping that the position will go in your favor. But I can tell you, losing money, okay, is a normal part of trading. And I said again, I'll say this again, losing is normal. If you have not lost money, or you don't exit a trade with a loss, then you are not a trader. And you just have to accept losing money. Trading is very, very different in any type of profession, in the sense that you can literally click a button, buy, and then the price goes up, and click sell within, let's just say, a minute, okay, or a few seconds. You could literally make money just like that. But you can also literally click a button and then in 1 second lose money as well. So you have to accept that losing is part of trading. Now, the goal in trading is you want to lose less than you make, because you will lose, okay? How much you lose will depend on where, if you put a stop loss on, where do you put your stop loss, or how many trades are you entering into? So if you always put on high probability trades, and those trades, some of them will work in your favor. And if that trade works in your favor and makes you 10 times, your loss, and what we call a 10-to-1 risk to reward ratio, then you can lose 10 times in a row and still be, break even. So you have to accept losing. If you don't lose, then you should not trade. If you cannot accept losing money, okay, absolutely, cannot accept losing any form of money, then you should not be a trader, because you can't equate trading to a 9-to-5 job where you put in all this time, put in all these hours, do all your research, and you hope to get rewarded for that. You will not. You can, if you win, right? If your trade goes in your favor, and that will be you'll think, oh wow, man, that's like the easiest money that I've made. I just press a button and it goes in my favor, and I get out, right, with a profit. But you also have to accept the fact that when trades don't work in your favor, you have to accept the loss. All right. Hi there. Can't pronounce your name. MD Monroe Islam. Okay. Lurking Lark, I've emailed you regarding the live stream lucky draw. I think I've emailed you the login already. If you haven't, then I'll email that to you again, Lurking Lark. All right. Yeah. Dennis says you sound like my boxing coach in practice about getting hit. Yeah. Like right. I'm not going to keep saying the same thing, but yeah, like in boxing, you will get hurt, but as long as you can, maybe wait for, you can literally be hit, and if you block it, get hit 100 times, but you can hit once, and you could get a knockout, right? So it's not, and in trading, I'll kind of elaborate a little further here. In trading, it's not about the amount of losses, or sorry, in trading, it's not about just the wins that will make you profitable. It's about the losses that you can manage and minimize that will make you a lot of money. And I've worked with some students prior to me working with them, is they've made money, but they also lost money. And then I look at their trading account for the month, is they barely make any money because they've made money, but they've give back their profits, and they don't take small losses. So losing is normal, and you just want to make sure that when you win big, and you win more often than you lose. And when you lose, you don't lose as much as you make. All right, so very simple as that. Lurking Lock says, I mainly trade QQQs and SPY options due to higher volume. Is that what you would recommend your students? I don't recommend anything. I mean, quite frankly, you can trade anything. I've throughout my 20 plus years of trading experience, I've traded penny stocks, I traded options, I traded futures, traded crypto, traded CFDs, forex, commodities, you name it, I've traded them. So it has to do with what do you like to trade? What do you see that there is opportunities? What is it that you do you like trading more stable markets? For example, trading a commodity like oil can be quite volatile than comparing to trading let's just say a blue chip dividend paying stock. So it just depends. And if you like trading options, is let's just say, for example, you don't necessarily need to be bang on in terms of your entry price or your exit target price. Like options is best is if you have a general idea what direction that you want to that you believe this asset will go in your favor, then it can be, options is great because you don't necessarily need to be that specific in terms of timing. Obviously, options has its advantages and disadvantages, but you just have to be comfortable with that. If you don't like to do lots of research on individual companies, then you can just trade the index, right? You can trade the Qs, the S&P, right? Just the overall general U.S. markets. So you don't have to focus on doing individual stock. So whatever your preference is, but it's more of what market do you have an interest in? Where do you feel that you can be good at? What type of market conditions are you trying to turn a few dollars into millions, or do you have a couple of decent amount of capital, but you're just looking for a stable type of return? So that's going to impact what type of instrument that you would trade. All right, guys. if there are no more questions, I just want to end this off. If you guys are interested in working with me, all right, I do have a stock trader development program. You can check it out here. And again, please, you can email me, contact@mikesir.com. Let me know what, or comment in the YouTube videos, what type of topics can I help you out with, right? I'm always looking for ideas on what videos to make, and really, the videos that I make, it's not for me, right? It's for you guys. So if you have ideas, you have some challenges, you have some topics that you want me to cover, next week in my live streams, please feel free. Like, I'm very, very generous in terms of giving my time. The reason why I like doing these live streams is allows me to connect with you guys, connect with you directly, and to be able to interact with you guys. So if you have any questions, you need any help, this is my way of giving back, and it's a way for me to help you with anything that you are struggling with as a trader. All right, guys. Thank you all for sharing your Sunday with me, and wish you guys the rest of a good weekend. And I'll see you guys here next week, same time, same place. Take care, guys.